We've got, as I said, a panel that comes with a range of different types of experience. We have Sarah Kearney, who's the founder and executive director of the Prime Coalition. The Prime Coalition is a mission-aligned, is an organization that works with mission-aligned investors to support early-stage, high-potential companies to help them move forward in terms of their maturity and their investment their development pathway. Second, we have Nikunj Jinsi with us, who's the managing partner for Better Futures Capital Partners. He comes with deep experience in the clean tech and the climate tech industry, including a number of years leading investing within the IFC. And then lastly, we have Luke Franson, who's the head of the Global Climate Partnership Fund Investment Strategy. It comes from responsAbility, which is a leading asset manager with a long track record in the impact space based out of Switzerland. Now, what we'll do is we'll invite each of them to share an example or a story of how they've begun to approach climate investing and looking for opportunities in the technology space. And then we'll have a short discussion, which will then be opening up to the wider audience. Maybe if I'd like to invite Luke to start off with sharing a bit of an example of something that you've done through responsAbility in the climate tech solution space.
No, thank you very much, Sean. Pleasure to be here. A real honor to be asked. Maybe I'll just start with 4 data points just to give people a high-level idea of what we do. So we have about just under $1.913 billion US invested since inception through the fund in climate mitigation efforts, and that is done through 80,000 sub-loans, sub-investments that we've done through our partner institutions in emerging markets. Currently, we work with 24 financial institutions. That's regulated banks, but also microfinance institutions, leasing companies, various MBFIs. And together they save about 1 million tons of CO2 per year. We individually calculate the CO2 savings on each one of those 80,000 investments. But those are all super high level numbers, and I think it's great that everybody have a lot of rigor around reporting good numbers, but it's really not, I think numbers are only tell the tip of the iceberg here. And I'd like to share a story with you that I think gets at the heart of what we see in terms of like last mile delivery, scaling innovation, innovative delivery platforms of what needs to happen in order to get down this low carbon pathway that's just really a must. I used to say that it's a must for our grandchildren or children. It's now, I think it's a must for us, right? This is now, we're going to see super real effects in our lifetime. It's becoming even closer and closer. And I think that's just more and more imperative. So the example that I'd like to highlight comes from Sri Lanka. This is one of the partners we've been working with since 2014, Pan Asia Bank. It's a second tier bank in Sri Lanka. We're the first international financing partner to work with them. And we started, typically the first place to start is just getting a financial institution's head around what is green lending besides renewable energy. Is it big? Is it dangerous? Is it scary? They have women clients walking in, they have SME clients walking in, they know tangibly what this is. When you say green, they have nothing that comes to mind, right? So we have to get very concrete about what kind of things that we want to do. So we started with hybrid car loan program with them, hybrid car leasing, which was very successful in 2014, 2015, but that's never enough for us. It was, we had really good numbers around it, but we wanted to push the institution to do something unique. We had a partner in Mumbai, that Ratnakar Bank, RBL Bank, that was doing a lot of good things with agricultural lending, solar pumps, drip irrigation systems. And we said, hey, let's bring these 2 people together. So we flew all the Pan Asia people up from Colombo to Mumbai, and they did a number of field visits and met people. This gave them the confidence to say, wow, there is actually real potential here to scale new technologies out and make a loan product out of it. So then we went out on field with them in northern Sri Lanka around the town of Ipalagaya. It's very rough roads, 3-hour drive north of Colombo. And there we started to see the outlines of how we could make this work. The service and supply arrangements there are not necessarily good, not what you'd find in India. So we tried to arrange for new supply companies to come in, because that's a key point of new technology, is people who implement new technology have to understand how to operate the technology, or else it just ends up being plastic tubing on the ground in the case of drip irrigation. We had one instance where, and different examples were solar panels. People don't understand what they do. They think that the solar panels collect energy that's beamed down via satellite. And so there's a lot of know-how in terms of what the technologies are, how they work, in order for them to be cared for and implemented properly. So we did all that. And then they started rolling out the loan product. And it was really interesting. On the day that it was being rolled out, some farmers were asked to speak, and I'll never forget one farmer saying, "Look, we've had lots of banks come here to our village, and we've had lots of people offer us, deposit products for our children, savings loan products, these types of things, housing loans, which we didn't quite understand, but no banker has ever arrived in our village with a ready-made turnkey solution that works for us, that helps us become more efficient as farmers." And that they had immediate buy-in in the village, because they came not just with financing and not just encouraging them to do something that they didn't understand, but they had a holistic solution. So that was key. And we're quite proud of how that worked out. And then the last bit, we continue pushing them, right? Because that's about scaling, and just, there's a lot of work to work with individual villagers. So how do we do this on a bigger scale? Recently, Pan-Asia started working with some of the big sourcers of papayas and sugarcane in Sri Lanka to work on a triangle of a guarantee program, where the big producers, because they also want more resilient farmers to supply them with sugarcane and papayas and things like this, that they're willing to partially guarantee the underlying loans for the drip irrigation systems. So this is another way that we push, and we continue to try to go up the curve to reach more and more scale. And then that's kind of where we want to end up in the future. That's our vision, is that we're no longer needed to bring these ideas to the institution, but there's a robust, keen market between financial providers that are willing to devise these solutions for local populations. That's where our vision is, where we want to get to. Unfortunately, it's a few more steps until we get there, but I think that last mile delivery system, there's a whole ton of innovation going on out there. I'm very anxious to hear what my fellow panelists have to say about how they support that. Once that comes out of the pipeline, I would be super excited to have my institutions start financing that and scaling that up massively, to not just reach rich people in big cities, right, but reach populations, agriculture populations, small rural villages. This is what's needed if we're going to have fundamental change.
Thank you, Luke. And I'm noting in particular the emphasis you make on scaling, which we often think about in terms of deploying technologies at wide scale. And so there's certainly a part of an innovation in the future of trying to lay a different technology base in environments which are probably still at where a lot of the infrastructure has yet to be built out. But also you're talking about scaling a financing ecosystem and an ecology around that technology, which I think is a part of scaling and growth that we often don't talk about in conferences like these. Maybe if we could then turn next to Nikunj and invite you to share some perspectives in the story of your experience in terms of clean tech investing and climate solutions.
Yeah, thanks, Sean, and the GIN team for having me on. It's a real honor to be on here. And thanks, Luke, too, for the very insightful story. It brings home with a lot of work we've been doing in the past, amongst others with folks like responsAbility. So as Sean mentioned, I'm focused now exclusively on clean tech investments in developing markets. And prior to that, I spent 16 years setting up and running the venture group at IFC, the International Finance Corporation, the private sector investment arm of the World Bank Group. That included clean tech investments, which we've been involved in from 2009 onwards. So lots of stories to share on that. But what I wanted to do is highlight Just give a couple of data points too, but also highlight one example, one project specifically that drives home what we've been doing and how we've been looking at the future. And as former panelists have said, and you heard it with Luke speaking, and probably as well on other panels as well, and other conferences as well, that technology is a critical enabler to scale up in markets and underlying markets. And I'd say it's more so in emerging markets. You'll hear the traditional cliches of leapfrogging and using the digitization ecosystem, and the fact that people are more and more getting digitized and having access to more data, and more people, even at the bottom of the pyramid now, getting access to smartphones and cheap data. And with that there's a whole sea change of development that's happening, and a sea change of opportunities that are happening. And what we were focused on at IFC was very much looking at enabling that through climate change, and particularly on the mitigation side in areas such as agri-tech, urbanization, but also logistics and mobility. So to Luke's point about last mile delivery, it's an area that we looked at very much. And just for context, what it means in markets, roughly speaking, if you look at logistics as part of GDP in OECD countries, so in developed markets, developed countries, it's roughly 5 to 8% of the GDP. In developing markets, it could range anywhere from 12 to 20%. So you're looking at doubling up. And that's not because it's a bigger industry, but that's because there's a lot more inefficiencies in developing markets. And there's a lot more efficiency gain to be had. And we believe that could be done a lot through sort of a low capex, data-driven approach in this space. So one of the cases I want to highlight of a prior investment we made at the seed round in a long-haul trucking business out of Nigeria, out of all places, in a company called Kobo 360. And Kobo 360, could be described as what people refer to as Uber for trucking, which I think is a wrong word, but wrong name, because essentially what it does, it develops a marketplace, a load board that allows for shippers and truckers and intermediaries to come on board to allow for a more level playing field in the business than there is right now. So today's market is effectively, you got a shipper wants to ship load from A to B. You got a trucker who comes on, or a small mom and pop store who owns 4 or 5 trucks. They come along, they bid for the shipment through intermediaries or directly. They get the load. The truck load goes typically from Lagos to Abuja or the other way around. And subsequently, the trucker delivers the freight, comes back empty loaded, and waits for another 10 days for the next freight. What the marketplace does, and out in the US and in Europe, you have similar kind of plays, although I think the efficiency gain is less. So in the US, you have Convoy. In Europe, you have OnTruck, which is a sort of comparable marketplace. But what the marketplace does is take away all demystification, and it allows for shippers to actively bid almost on a real-time basis. It allows for truckers through the smartphone to look at what loads are available. And most importantly, it takes a truckload from A to B, gives the opportunity to take even a partial truckload, which is an important characteristic. You don't always need to have a full truck, but takes a partial truckload from B to C, and subsequently takes another partial truckload from C to A. So I'm purposely simplifying it out here. But what it does, it creates more efficiencies in the market. It creates better options and opportunities for truckers, more income for the truckers, and very importantly, it creates a system with less trucks on the road as a result, and therefore CO2 gains. So the mitigation part of this is often underemphasized, but there's a lot of climate mitigation what one can achieve by having sort of more efficiency in this space. And so where we came in, it was actually at the seed round, early days in late 2017 or early 2018. They had a handful of trucks on board, and the concept wasn't really understood. It was happening in other markets, and I'll get into that a bit later, but we've invested earlier in places like China and India into similar plays, but the concept wasn't really fully understood in Nigeria. And fast forward to today, company went on and raised another $30 million round, was able to grow the business, its ecosystem, was able to brand itself further, and is now in the midst of raising another $50 to $75 million round. They have 20,000 empaneled truckers on their system and over 300 SMEs, shippers that are ready to, that are actively working with these businesses on a daily basis. Huge amount of CO2 savings. It's it's in the millions of CO2s, not in the thousands, millions of tons of savings. But there's an opportunity like this in many markets. And part of this, the theme on this panel was to look forward at 10 years ahead. And I think we're already being faced with that. So where I take on a fairly simple example of Nigeria, in the early days in 2016, we had invested into a similar play out in China, which was at that point called Hochbang, and subsequently now it's named Full Truck Alliance. Numbers are bigger, no doubt, in China. It's we're talking about 6 million truckers now on the panel, and panel truckers on the platform, and several thousands of shippers out there. Company is going to be listing. You'll hear about it next week. It's going to be listing on the NYSE next week, and they raised well over $1 billion prior to its listing, and they're looking at a couple of $100 million after listing. The reason I'm raising them is that because one of the technology enhancements they're looking at is autonomous trucking. And with that, they've literally looked at acquiring software companies out in the US and in China to allow the truckers to actually be at least partial autonomous. And for those who are looking at the space, long haul distance driving will probably be the first market in which you're going to see partial autonomous level 3, level 4 kind of autonomy driving implemented. And so keep an eye out on this. So what's happening out in China, and it's going to be happening in other parts of the world also. You will see happening in our example in Kobo 360 in Nigeria as well. In terms of approach, I think this is also a very important approach where you're looking at a data-driven, low asset focus on creating efficiencies and immediate gains for the whole ecosystem. And we've seen many similar kind of opportunities out in the agri space and the broader urbanization space. But I thought this would be one of the more telling and meaningful examples that would be able to tell people what's likely to come going forward. Back to you, Sean.
Thank you. And so a very different kind of example where the technology, the opportunity is inspired by recognizing how technology is changing the opportunities for how we manage ourselves or how we conduct economic activity, but it's not a technology that in and of itself is directly trying to change an energy input or directly mitigate an emission. It's a technology that allows for a different behavior set and kind of takes the new behaviors that are entering into the economy and applies it specifically to how do you help solve some of the climate challenge. But again, very much also a question of taking some of the technology that's a little bit farther out from what Luke was talking about, but is still here today. Maybe then, and I'll also just put a quick note in for the audience, please feel free to go ahead and start loading in any of the opinions you have, observations, or questions. After Sarah, I'll probably ask a question or two to the panel, but then we'll also immediately start trying to draw on any observations that you have. Maybe next turn to you, Sarah, and I know that you work in probably much longer time frames than the average investor does, but that's also important because there are lots of opportunities within that. So over to you to share some thoughts and experience.
Thanks, Sean. Hi, everyone. My name is Sarah Kearney. I live outside Boston, Massachusetts in the US. I founded Prime Coalition in 2014 based on my own experience having worked as an executive director and trustee of a private family foundation based in Rochester, New York. And I am very grateful to Sean and his teammates at GIN for including climate as a critical theme as we reimagine capitalism together today. As background, Prime's vision is a safe and equitable planet for all people. Our mission is to mobilize catalytic capital toward climate solutions. And our values are passion, authenticity, and fact-based analysis. So Sean asked us to speak to 3 prompt questions today during our 5-minute opening remarks, and specifically to talk about an example investment in our own portfolio. Prime has now partnered with over 170 courageous philanthropic organizations and mobilized $90 million to support 23 companies, where each company in our portfolio promises at least 0.5 gigaton of CO2 equivalent emissions reduction cumulatively by 2050 if it can achieve commercial scale. In the context of my fellow panelists, my firm is focused on US-based technology innovation that has many deployment opportunities in places that matter, both inside and outside the US. I'm going to focus my comments on a US-based company called Charm Industrial as my case study. I'm doing that because it's a celebratory story about the importance of carbon removal solutions in addition to carbon mitigation solutions. I'm also doing it because it's not sexy and it's at times not relatable because it's a B2B company that most of us will never see. And because Prime's investment in Charm demonstrates the outsized impact you can have with a small amount of catalytic capital very early in a venture's life by taking disproportionate risk at a time when mainstream investors are not yet able or ready to go first. And so the first prompt question from Sean is, what are you imagining the world will look like in the future, and how did it inspire you to choose this investment? We know we need to reduce annual greenhouse gas emissions by 70 gigatons annually by 2050 if we're going to avoid the worst consequences of climate change. And all wind power ever deployed globally is equivalent to about 2 gigatons. So we need 35 times all wind power ever. And this requires that we deploy the proven solutions of today in places that matter as fast as possible, and that we develop the unproven solutions of tomorrow, and that we pursue achievable carbon negative solutions. And so Prime's 3 underwriting criteria are: number 1, each company must promise at least 0.5 gigaton of CO2 equivalent emissions reduction by 2050. Number 2, there must be a path to commercial scale, which includes attractiveness to follow-on commercial investors. And number 3, we must make a strong case about why the company might not achieve its climate impact without Prime's involvement. So Charm Industrial, as a for-profit company, its mission is to return the atmosphere to 280 parts per million of CO2 profitably. Their core business is to produce bio-oil and then either sequester that bio-oil in geological reservoirs as saleable negative emissions, or gasify that bio-oil to produce green hydrogen for fuel cells, refineries, or ammonia production, or gasify the bio-oil to produce syngas for steel production. So Sean's second prompt question is, what are the friction points that you needed to solve in structuring your investment? And so in the summer of 2020, Charm had a very underdeveloped business plan. And Prime has an investment advisory committee comprised of 20 of the most active mainstream climate venture funds. Our investment advisory committee members agreed that Charm was too immature to fully understand its own potential risks. Many expressed the desire to see a more developed plan in order to assess Charm's value proposition, its business objective, and its path to market. And our investment advisory committee believed that the company's path to profitability is so far down the road that conventional investors would be uncomfortable with that risk. They thought the size of the initial market was unknown, and they had concerns that Charm's first target market for negative emissions would not be large enough for the company to become profitable in the timeframe required for their funds. Charm needed to raise $600,000 in a pre-seed round. And were it not for Prime, the company wouldn't have been able to raise money from an investor that was impact aligned and had deep experience in growing industrial hardware companies in order to set Charm on the path toward maximum climate impact. So Sean's third prompt question is, how do you see the technology area of your investment scaling in the future? I'm going to share with you an investor update that we just received on June 1st from Charm, and I'll read it. This week, we closed our Series A, and we now officially sequestered 1,820 tons of CO2e in Oklahoma for Stripe and Microsoft. This is 10 times more CO2e removal than the entire direct air capture sequestration industry to date, and we did this in just 14 months. Going forward, our team is pushing hard to deploy our first Charm pyrolyzer and Charm injection well in Kansas this fall. So Prime did not participate in the Series A because Charm had graduated from additionality. It didn't need us anymore. And as you can tell, the company's future is very bright, which means the likelihood of meaningful emissions impact is high. And we're hoping to repeat this story as many times as possible in the coming 20 to 30 years at Prime and beyond.
Thank you, Sarah. And so, I mean, here you're sharing with us an example of a technology that, or a company that's not just trying to take something and improve on it, but it's actually trying to change the opportunity set that exists for the economy and the planet as a whole. Actually reminds me of a paper I saw, an article I saw in the paper today about a research lab that's invented bacteria that can convert plastic bottles, use plastic bottles into vanilla. Totally changes the options. Which, you know, the efficiency solutions are still needed, especially in like a near term, but we also need to have these investments into technologies that will start to change sort of the rules under which we're able to think about operating. And I think you've also brought out an important point about the support that early stage investors can provide, not just with the capital, but you specifically made the point about bringing some of the business expertise and some of the insight that can help these emerging companies get out of laboratories, or emerging ideas get out of laboratories and to the point where they start to become commercializable. And I'd kind of like to pick up on that last point with the sort of a question to the three of you, because it goes to this question of sufficiency, and it's also something that's already come through from the audience. When you're looking at investments and you're entering into a climate solution investment, obviously because you see the wider climate problem, and the wider climate problem has a very unforgiving science. There's certain concentrations. When we hit those, there's no negotiating. We will start to see certain changes. So having investments that do something is better than investments that do nothing, but we need investments that we need to also think about whether or not the investments are doing enough. But obviously that also starts to become a choice about what sorts of risks you want to take on in terms of the potential for the change. So I wanted to sort of invite a question to the three of you about how do you think about evaluating the climate change solution potential when you're looking at technologies? And how do you think about what's the appropriate level of ambition, or the level of ambition that's accessible to you, given the type of investment appetite that you have, the type of capital that you have to deploy?
Should I take first stab? No, I just come with a small example, then I'll hand it over. I had this question earlier today, actually, when we were talking about investment efficiency. So we also monitor and look at, of course, tons of CO2 saved per dollar invested. If we took only that frame of reference, we would be just plastering Mongolia with solar panels. Like that's clearly just like, that's the thing to do, and that's all you should do. You shouldn't do anything else. I think that's short-sighted, and there's, I mean, as people earlier on in the R&D process, my fellow panelists will attest, you need to think holistically about ways in which the entire system will change, because especially in emerging markets, you need to have catalytic leapfrogging technologies. That's the only way we're going to get there fast enough. And that requires an investment period, which by definition requires a J curve, right? You're going to have sort of upfront investment costs that you need to amortize. How do you do that most effectively? And can you get to a place where you have a result at the end that's commercially viable? That's a little bit easier on my side, because I have local financial institutions who are very good at understanding if something's commercially viable. I think it would be interesting to hear how my panelists see it. But we look at what we call the ecosystem approach, that if you develop an ecosystem for green lending or in climate change, climate friendly tech, that ecosystem is most likely going to be long-term a better investment than just plastering Mongolia full of PV panels.
Yeah, and I'll add on to that. So thanks for that, Luke. Is that, the way to look at it is effectively first, maybe not even like climate first, but like make sure that climate is part of the framework. But what problem are you looking at solving for the underlying economy and the underlying market first? And so, as we all know, there are parts of developing markets that don't have proper access to energy and will never get, a generator or a traditional fixed energy outlet provided to them, and akin to what happened in the telephony world, where many people swap from fixed line into mobile, and not swap, but they actually moved into mobile directly without knowing what a fixed line was. You're seeing similar kind of distributed technologies and options come into developing markets. I would emphasize that a couple of things. One is what Luke was mentioning, that you need to have commercial viability first. Without that, you're not going to get long-term scalable impact. And that's a tougher thing in venture, especially at the earliest stage, especially in developing markets, than it is in working with local financial institutions. The other thing is that, while it is always cool to look at new projects, it's also important to make sure that we go about it in teamwork. So going about it alone is generally not a good idea. I'm saying generally, there is too much effort involved, joint effort involved, and billions of dollars on an annual basis that are involved in having to solve the challenge that we're looking at. So the more parties you can get around the table, the better it is. There's more brains around the table who come up with their own investment experience, the better it is. And the way we've been looking at these kind of opportunities at the early stage is looking at, one, unit economics. Does it work? And how do we manage to then scale up? What does that J curve look like? And, from our perspective, from a financial perspective, you really want to reserve follow-on funding, because the execution plan never actually happens the way it should be. But what does the J curve look like? What will success look like from an operational perspective? But the unit economics probably are the hardest thing to look at. And, you also got to be brutally honest and clear with yourself. So, for example, we invested quite a bit into the solar home space in Africa, which has, all the characteristics what I just mentioned. You're providing energy and critical energy towards people who don't have access to it, can do simple things such as charge up the mobile phone, listen to a radio, have a small fridge generator, have a small fridge operating in their home, and with that increase the productivity. Yet at the same time, what is now only happening is that you're developing customer finance solutions alongside to allow for that scale up, because even at the early stage level, where you're selling a $150 solar home system in markets that can't afford it, you need to develop a pay-as-you-go model. You need to develop a credit system to allow for that happening, and that's only now happening. So while all of these things look great, and to Luke's point, we could be putting solar home systems in Africa and solar panels in Mongolia all day long. There's got to be that sustainability effort and that sustainability model that needs to be worked out. And it's non-linear thinking. You've got to think about holistically about all things that come into play in this space.
I'm going to pile on here and just say that I have 4 quick comments. At a very high level, measurement, tracking, and management toward emissions is important. It is vastly insufficient in terms of the lens on climate justice globally, across so many different impact consequences, positive and negative. That's high level comment number 1. I think that agrees with what Luke and Nikunj just said. Number 2 is that venture capital as an asset class has a unique challenge. If you focus on emissions for a second, a lot of frameworks and work has gone into assessing what is happening today and what has happened in the past. It's very difficult for an asset class that is primarily forward-looking to say, here's the impact that we expect these businesses to have in the future. And it's just fraught with uncertainty and difficulty and data management challenges. So I have an offer for the community of people on the phone, which is that Prime has been sponsored by the MacArthur Foundation and the New York State Energy Research and Development Authority to take our methodology for forward-looking emissions assessment. And we built an open source free software tool online. It's called Crane. You can visit it at cranetool.org. The idea is just to kind of get you as far as we can and giving you a nicely maintained, cleaned up data set to help you do that forward-looking impact assessment. I'll also say that we're in the midst of trying to launch an effort that will give resources to venture capital asset owners, asset managers, and corporate investors to help them do this work, because it's really prohibitively difficult for a lean business model. The last thing I'll say for Prime specifically is that we do so much pre-investment around our underwriting criteria. Like, we have to calculate the emissions reduction potential of each company because it's one of our investment criteria. And we have to do a really rigorous job around assessing additionality because it's one of our underwriting criteria. We want many investment firms to be able to do that, even if it's not in their underwriting criteria, right? Like, if you're doing it for awareness, or you're doing it to inform your investors, like whatever your level, your burden of proof is, you should be able to do the exercise to inform better, more climate optimized decision-making. The last thing I'll say is, if you look at the 7,000 pre-seed and Series A companies in the US that touch emissions in some way, some of them will be supported by mainstream investors. Many of them have insurmountable challenges and are kind of bad investments, but there's this middle ground where they might not be attractive to traditional investors, but they could someday become very attractive. Even within that group of kind of in need of catalytic support, there are some businesses that are in lockstep with impact goals and some businesses that are not in lockstep. And so some of the steps that we have taken as a nonprofit investor are that our investment managers, in their carried interest, 50% is what we call financial carried interest, 50% is mission carried interest. And so when a company exits, our investment manager only participates in that if it's gated by kind of mission related standards. And it has to do with negative unintended consequences outside of emissions. It has to do with accomplishment of emissions reduction. And so that's a really complicated and important set of things that I think we're kind of in the very early days of investment managers pioneering those types of approaches for incentives for managers. We have climate impact milestones that are like operating guideposts for our portfolio companies with an oversight committee. And then now we're just constructing our next vehicle, which will have even more influence through the combination of a catalytic sleeve with a full cycle sleeve, where one is charitable and one is not. So to me, we're in such early days of kind of figuring out how the mission priority and the financial priority can work together in more complementary ways that actually is mindful of some of these very complicated impact questions.
And the measurement point and the tools for doing that for the forward-looking investments, particularly important for anybody that's joining the movement towards making net zero commitments. If you make a net zero commitment, almost by definition, you're going to have to be investing into something that has the potential to remove or somehow pull you below, because there will always be some degree of emissions from a portfolio, and you'll need some part of your portfolio that is trying to address that, because there's a limit. They'll run into a limit in terms of what can actually be achieved through efficiency and mitigation, and that's a tough challenge. And having some of those tools available are really important. And one of the things that I'm hearing in the common point that I'm hearing across what you're saying, I guess 2 points I'd pull out in particular. One is talking about looking at climate solutions in the context of the wider market or the wider sort of economy in which it needs to thrive. And I think you've talked about that in the context of as something is going down, either in the context of something which is early stage and needs to find its pathway to commercial viability. That might involve needing multiple types of investors that are willing to take on different risk exposures, or even in the case of something like the solar panels that you mentioned, that's a relatively mature technology, but it needs to have an ecosystem of additional financing or financing of customers and supply chain that will make it possible for the particular solution that you're investing into to be able to scale. I wonder if you could share some examples of how you've tried to think about these investments holistically. An example of perhaps something different you could build off, and in some ways you've answered this in relation to the investments that you've done, but maybe thinking in terms of other examples of, as you were looking at an opportunity, what were some of the additional pieces or that you thought were going to be important in terms of other businesses investing alongside, or in terms of having an exit strategy, or how you would be a bridge towards an exit strategy that sort of would help kind of maybe describe this idea of holistic, because climate solutions by definition are sort of a forward-looking investment. You're investing into an economy that will be developing rather than one that is 100% here today.
I can speak to this a little bit. This feels like a definitional question for Prime. You know, since 2015, we first did this in syndication mode, where we would bring together small groups of catalytic investors, one company at a time, to kind of explore the boundary of what you're allowed to do with catalytic capital. And then starting in 2018, we were actively investing out of Prime Impact Fund, which is a $50 million seed fund, 100% catalytic. And like I said, we're now kind of constructing our next vehicle to have a catalytic sleeve and a full cycle sleeve. But the underwriting criteria has remained unchanged, which is at some point, our goal is for each company to graduate from needing us. And so the whole purpose, and especially for these kind of hardware, capital intensive industrial solutions, it is critical that you have very aligned and deep pocketed co-investors. If you can crowd them into the early stages, awesome. But even more critical, once the company kind of graduates from needing catalytic support, that you build a healthy syndicate that's going to be able to carry it through commercial deployment. And we know from kind of observing and analyzing past data around successful paths to market that all of the most successful companies at some point have a stumble from a financial standpoint, a down round or a pay to play. And so trying to maintain as much influence toward mission becomes very important when you start thinking about the trajectory of finance from very early stage through large scale commercial deployment. One thing, a second example I'll give is we invested in a company called Lilac Solutions, which it really is changing the way that you might be able to draw lithium from natural resources. It's a environmentally harmful process now, and Lilac solution makes it so that you can avoid the kind of salting of farmers' fields in South America where lithium resources are rich. And so there are lots of kind of social and environmental co-benefits, even though we hung our hat on the emissions reduction potential of the lithium supply chain. And so I think thinking through all of that and making sure that you're amply supporting early stage companies and their consideration of communities where their products will eventually be deployed is a critical part of the support, so that as they graduate, they'll kind of be mindful of that along the way. I'll stop there. That was long-winded.
Yeah, I'll just add on to and what Sarah just mentioned. I think there's lots of examples of holistic way of looking at things. So, and to make sure that they're not negative unintended consequences. So, for example, in the project I mentioned on the truck drivers, you want to make sure that their rights and on one hand they're not. This is the whole Uber discussion we've been having out in the U.S. as well, but the fact sure that the truck drivers actually have rights and there's some basic sanitation standards involved in that. There are many examples in which we've invested well over $500 million into direct climate plays over the last 7-8 years. There are many examples in which we too invested into renewable battery space technologies, where you want to make sure that the ESG components around there, whether it's mining of the critical materials or whether it's like just maintaining a proper sanitation and proper standards for factory workers as we scale up those businesses is critical. But I think what is important also, and what you were alluding to, Sean, was also the fact that you want to also make sure that the investor ecosystem is there. And so what we did a lot was largely making direct investments into companies at a later stage. So on one hand, you want to make sure that there's alignment with the early stage investors, typically alignment financially, but also make sure that these are folks who know more than you do, either from a regional perspective or from a sectoral perspective. And you got to be also very clear what you bring to the table, whether it's like sector knowledge or whether it is knowledge of, sort of the broader sector globally, or you have particular knowledge on impact and ESG standards that you bring, and you bring us stamp of approval. The other thing we would do is invest often into fund managers at the early stage. And so developing that ecosystem of a network of aligned co-investors is important. That also helps you in sort of mapping that J curve. It is impossible, I find, still after 20 years of investing, to actually really pin down and which year we will look at exit of the company if everything works out. But you want to eyeball it typically, whether it's a 5-year exit horizon or 10-year exit horizon. It is also important not to take the typical venture mentality in climate. If there's anything we've learned, having gone through that from the Climate 1.0 perspective, that you can't look at investing into companies and hope to get your money out 3 to 5 years from now. There are other products that are needed. More permanent capital is needed. You want to make sure such kind of sources are around the table to actually allow those products to grow. And I can give examples in anything we've invested in. We've invested in solar panels, we've invested into renewable batteries, we've invested into panels for the rooftop for commercial and industrial players, as well as for homes, and in the whole agri space. And I think what I've just mentioned is true for all of these sectors. So this goes across sectors. Focusing on the ecosystem, make sure that you know who the early stage players are. Be very clear about what you bring to the table. Don't overvalue yourself on that. And then be realistic, if anything, on your exit horizon. And it's going to take longer rather than shorter in most cases.
Yeah, I could just add, one thing we don't look like when we invest and one thing we do like when we invest. I was in a call a few months ago where the CEO said, our business strategy is to grasp low-hanging fruit. Great. Like, that's business strategy of everybody, everywhere, like that's fine, but it says nothing. And just sort of inorganic growth, blindly just growing for the sake of growth. This is stuff that we're not interested in, right? This is not attached to a strategy. It's not attached to anything meaningful. What we are interested in are institutions that are willing to talk to people who they don't normally talk to. And they throw themselves into new ways of doing things long before any of their competitors have thought about doing it. And that's for me, the promise in climate change and the massive change in investment that's going to be required, whether we like it or not. It's scary, but it's also a gigantic opportunity where those who think quickly and differently and in an interdisciplinary way and are willing to talk to people that wouldn't normally talk to, in my view, those are going to be the companies that are survivors and grow and thrive in a really, changing, crazy environment that we're about to face. And those are the ones that we look for, the ones that aren't scared to talk to somebody new, aren't scared to maybe not just go for the low-hanging fruit, but go for the fruit that's higher up and takes a little bit more effort to get. But that's going to be something that positions that company in a way that put them way ahead of their competition.
Sean, I want to add on to that, because I love this analogy to low-hanging fruit. As a catalytic investor, you do not want to touch the fruit that others will grab without you. Even if it's like really juicy looking and is right in front of you, I think being disciplined and thinking about the unique value proposition of your ability to grab anything obligates you to grab the ugly fruit that nobody else can touch yet, but that might someday be lower hanging for others. Thank you for the analogy.
Well, and I think it's a fitting, we're coming right up on the close of our session. And I'll give you all a moment, just if you have a closing thought you'd like to add, but I think it touches on this, your last comments about people that are thinking differently, about some of the complexities in terms of investing into the space, because it does come with question marks, and people tend to think in terms of risk reward, right? So if I take on more risk, then I want more reward. But I think that, and that's very obviously true in any aspect of investing, but I think some of what you're talking about is to say, yes, there's risk reward, but in some ways the reward is on a scale that is hard to compare to any other sort of situation or any other investment opportunity where you typically think about a risk reward balance, because it really is investing into a new part of an economy or sort of a new version of a sector or an area of economic activity. And in some ways defies a little bit of the traditional ratios that you might apply when you're trying to think about, I don't know, what some think about a more traditional investment set. We are going to have to move and close this session down in about a minute or so. And I can see Christy is already giving people in the chat the note to use your unique access link provided in your registration to be able to go back to the main session. So this is, moderators always close by saying in a sentence or in 30 seconds, do you have any closing thoughts? They never really mean it, but this time I think we probably do. Just give each of you a chance to have a closing remark if you'd like to. I'm just going to go in the order that you appear on my screen, which is Nikunj, Luke, and then Sarah.
Thanks. So as you say, Luke, there's a risk reward curve, but given the world we live in, climate investments are a lot more complex. You have a lot more parameters to look at to understand whether you're looking at it from an enterprise perspective or from a consumer perspective. It's a lot more complex. You got to think much more longer term than typically people look at from a, this is not a traditional, online pizza delivery play, which you could be very lucrative, but you've got to think about a lot many parameters within climate investments. And the good thing is that while the other panelists have said it's a lot more complex, it also comes with a lot more opportunities because it's tangible. You can actually see the results, but you need to be patient in this space for a long time.
Luke?
No, I can only underline that. I mean, sometimes I think back to a book I read that outlined there's a situation at the end of the 1800s where you extrapolate the number of horses needed to pull buggies through London and New York, but in a few years, London and New York would be under 6 feet of manure. They just wouldn't be able to deal with it, and if you were, putting your investment strategy into the horse and buggy trade, then you'd be really idiotic, even though it seemed like a growth opportunity. So I think that's sort of my parting thought for the future, that, let's try and figure out what the Ford motor cars are of tomorrow, the really things that are going to solve these problems holistically, revolutionary wise. And people, one last call, people in emerging markets are really smart people. Like they're doing great things, and they need a little bit of access to capital. They need some investment, and they need some people to have a bit of faith in them. And I am so optimistic that they can do amazing things.
And Sarah, the last word.
Ooh, I took my breath away from Luke. I have two takeaway message. One, if you are not already thinking about how to partner with catalytic capital in a purposeful way, you are missing out. That's takeaway number one. Takeaway number two is that if you are an asset owner that invests in funds at any amount, you have to demand that your managers make the time to measure, manage, and report back to you on impact. Even if they feel like it's prohibitively difficult on this topic, it is time to start. Those are my two.
Okay. Well, with that, I'd like to close the panel session. I'd like to thank our panelists for sharing their experiences with us today. And I'd also like to thank all of you who've chosen to join us for your time and attention and active interest in the topic. I'd like to invite you now to return to the main sessions, and you all will have an individual access link. If you have any questions, you can put them into the chat, and Christy, our tech person, will be able to help you out with that. Otherwise, thank you very much, and we'll see you back in the main room.